Well, welcome everybody to my Market Insights. It is February the 9th. I am fresh off of a lovely weekend in Sundance. If you've never been to Sundance, that was property that was previously owned by Robert Redford. He sold it in 2020. Still has a lot of the charm when he was an owner. Um, they built a new inn. It's really a wonderful place, but I got a ski in, ski out cabin, but we didn't have any snow. There was no skiing. Well, there was some if you want to ski in mush. Life's too short for that. But we have storms are rolling in. So, as luck would have it, I leave. It looks like now snow is on its way. But you know what? I can go back. I hope you're off to a nice start to your week. The markets have definitely done an about face. Last week, things were feeling kind of crappy. And I was looking for some catalyst other than, okay, the prices have dropped so much, people are going to start purchasing. Really didn't find one or see one, but that is what happened. A number of high quality names went on sale. People have taken advantage, driven the price higher. So that's awesome. I'll take it. I'm sure you will too. All right, let's get to it. Quick reminder that everything that we do here is for educational and informational purposes only. It is not intended as investment advice. So, what's moving the markets? The Dow climbs to a new record high. So, in the midst of all of that drama last week, we now have a new record high on the Dow, which exceeded 50,000. Trump did a tweet where he said, by the time his term is over, that we'll be at 100,000. Likelihood of the Dow doubling from this point in less than 3 years, I'm not seeing it. It'd be awesome, but I'm not seeing it. But the fact that it hit a record high, that's pretty fantastic. NVIDIA and Broadcom sharply higher for the last couple of days. Again, the recovery, which is great to see. Latest CPI figures are due out on Friday. So there is a potential market mover. Um, and there's something known as trueflation. If you want to Google it, you can. It was actually down 1%. So we're hoping maybe CPI, is going to come in a little lower than expected, which increases the probability of the Fed cutting interest rates, which is a fantastic catalyst for the equity market. We'll see. 10 years dropped a little bit. It's now below 4.2%. Haven't seen that in a month or so. And oil prices moving up toward the mid 60s at 64.24 a barrel. Well, I'm thinking about it since I've reported on it. Let me give you kind of the latest relative to precious metals. Um, Gold is back up over 5,100 and silver at 83. Remember when silver sold off 32%? Hopefully, if you had positions in like the SLV ETF, you didn't go selling. I know I didn't. And now we've almost made a full recovery. We're getting close. So that's what's going on. Market breadth for last week. Um, Advancers versus decliners. So on the New York Stock Exchange, we're in pretty good shape. 1719 advancers, 1104 decliners. But look at on the NASDAQ, which is tech heavy, 2255 advancers, 2816 stocks were lower. And look at new highs versus new lows. There were more new lows than new highs. We haven't seen that in a long time. Now, on the New York Stock Exchange, which is not tech heavy, dominated by new highs. So, kind of a mixed message there. Small caps have definitely taken the lead. If you look year to date, small caps are up 5%, large caps down 3.4%. And I really think this is a byproduct that these large cap companies, their prices were driven up, 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 up. And the market was looking for somewhere where it could find value, and it found it in small caps. Last week's heat map. So, I mean, you see some blood red on here. Meta down over 7%, Alphabet 4.5%, Tesla 4.5%, Amazon 12%. Um, the software companies continue to bleed red. Big tech, by and large, red. Microsoft off 6.77%, Nvidia almost 3%. But look what's up. Consumer defensive, like consumer staples, industrials, REITs, and healthcare, specifically on, the big pharma side. Also, the financials were up. So definitely a mixed bag last week. Here's our market scoreboard. Let's just look year to date. The Dow up 4.3, the S&P is up 1.3. So there are people that in their mind, they think the market's collapsed this year. The S&P is actually up 1.3%. Now, the NASDAQ, I mean, some tech stocks, mostly software companies, have been hammered. But as a group, NASDAQ's off less than 1%. So oil's up 10% for the year. Old economy sectors outperforming while tech stumbles. So this is over the last 6 months. So there's software down 27%. Chemicals up 7%. Transportation 18%. Oil and gas up 21%. Sector rotation from last week. Look, there's consumer staples, industrials, materials, energy, healthcare, just what we were talking about, financials, REITs and utilities were on the plus side. Tech was off about 2%, consumer discretionary 2.5%, 3.5% for communication services. The VIX had a temporary spike, as you can see right here, got up to almost 22, and now it's back down to 17. So you'll notice when you get a spike in the VIX, what happens? Every single time, panic selling, and then people start to regain their composure. Panic selling, time after time after time. When you recognize these patterns, it becomes pretty clear what you ought to do. Earnings are looking strong moving forward. So this is 2025 calendar year, and then moving up 26, 27. Earnings are the mother's milk of the market. So barring any black swan events, geopolitical events, we expect the market to continue to climb. AI spending. Now, focus over here. Year over year increase. Amazon, 60%. Alphabet, formerly known, well, the Google division, 97%. Meta, 73%. Microsoft, 41%. Tesla, 135%. But Apple's being like the grumpy old man, guilty, up just 2%. Look at the spending from Amazon, 200 billion on AI. Apple, 13 billion. Who ends up winning? We'll see. Might be those other groups overspent. Now, this is interesting. The Magnificent Seven, their earnings have been cranking it, but the PEs have barely budged. So there's been no real PE expansion. In fact, a bit of PE contraction. Might it mean that Magnificent Seven stocks are poised to move higher? Probably, especially after this recent pullback. Now, here's a good omen. Now, there's a lot that goes into this, all right? But see if you can follow. The S&P 500 after the VIX was down at least 18.4%, right? So the VIX spiked and then it came back down. While the S&P is within 5% of its all-time high. Where are we a month later? 100% of the time, the market's higher. Interesting. We'll see. You know, streaks are streaks until what? Until they're broken. Um, so white collar job opening rates plunging. Everywhere I hear the same thing, that it is tough to get white collar jobs. You know, if you want to go into construction, operate a crane, all kinds of opportunity. And we still haven't seen the full effect of AI here. So, I mean, look, this is information down, finance and insurance way down, professional and business services down. And it's going to get exacerbated. All right, let's take a look at charts. Check in on the S&P 500. And so it had, as I noted last time, briefly moved below the 50-day moving average. But my advice is when we get below the 50-day, give it a few days. See if it stays down there. Because, you know, we crossed below the 50-day here, it rebounded here, rebounded here, it's rebounded again. Now, the real question, I bring this up, I'm going to bring it up until it's no longer an issue. Can we get above that level? Are we going to see the S&P at 7,000 and hold there for a few days? If so, we could be off to the races because what is being set up right now is this wedge shape, which we call a breakout pattern, where typically we get a big move. Where the move's going to go, it'll depend. Do we break above the upper trend line? Boom, we head higher. Break below the lower trend line, that is a different story. So, all in all, thanks to the last couple of days, we look like we're in pretty darn good shape. And I hope all of you are in pretty darn good shape. And I'll be back again, same time next week. Till then, be safe, be blessed. Bye for now.